Welcome back, Mike here. Right now, the ETF market is sending a split signal, and if you're only looking at price, you're missing the real story. On the surface, everything looks bullish. Tech is leading the charge and QQQ is seeing heavy call buying. What? Strong earnings from Apple helped ignite a broader tech rally, and traders are clearly betting that momentum continues. But here's where it gets interesting. Underneath that bullish momentum, we're seeing something very different. SPY just printed over 4.2 million contracts, and a large portion of that activity is put spreads. That's not aggressive bullish positioning, that's downside protection. In other words, while the market is pushing higher, smart money is quietly hedging risk. Now shift your focus to small caps. IWM is showing rising volatility, with an elevated put/call ratio. That tells us uncertainty is building, especially in the more economically sensitive parts of the market. And then there's bonds. TLT is seeing strong call buying, particularly in longer-dated contracts. That's a clear signal traders are positioning for potential rate cuts later this year, even though inflation data has been running hot. So let's put it all together. Tech is strong. The broader market is hedging. Small caps are getting volatile. Bonds are pricing in policy shifts. Backhand index pointing right. This is the key takeaway. The market is bullish on the surface, but defensive underneath. And this kind of divergence matters. Because when momentum and hedging move at the same time, it often signals uncertainty ahead, not just confidence. So if you're only watching the rally, you're only seeing half the picture. The real edge comes from understanding where the money is flowing, and why. If you want more fast, no-fluff breakdowns like this, make sure to follow, and stay one step ahead of the market. Thanks for watching. If you found this helpful, hit subscribe and turn on notifications so you don't miss the next video.